Now, since they've made real improvements, though, there's some good changes here. They brought in a new CEO, Vivek Shankran from PepsiCo. Smart. They spent billions renovating the stores and building out their new omni-channel business. They now offer delivery at the vast majority of the locations. Most importantly, they paid down a lot of their debt. When Albertsons tried to come public in 2015, its net debt stood at a colossal $12 billion, close to $12 billion. Then they brought it down to $8.7 billion as of the end of last year, which is a much more reasonable number for a company that generated $2.8 billion in earnings before interest, taxes, depreciation, and amortization last year. And you know what? All these moves are working. After years of stagnating, Albertsons sales grew by more than 3% last year, 2% same-store sales growth. Not bad. Big improvement of where they were. Even better, by paying down all that debt, they've given the earnings a dramatic boost. Last year, Albertsons made $466 million. That's up from $131 million last year. And most of that increase has to do with smaller interest payments. I like that. Oh, and we know that they've been getting a major boost from COVID-19 because they just gave us a business update last week. Albertsons says they've experienced, and I quote, significant increases in customer traffic, product demand, and overall basket size in stores and its commerce business, end quote. Since the company's fiscal year started in March. That's really good. Get this. Same-store sales increased by 47% year-over-year in March, up 21% in April and May. That translates into 30% same-store sales growth for the first quarter of the 2020 fiscal year. Other supermarkets have had similar. That's what happened during the pandemic. The company's margins are picking up, too. That's great. And that's in part because of better execution. I told you I brought in new management. Thanks to all this money coming in, management said they've gotten their net debt load down to $6.7 billion by late May. Manageable. Just cleaning up that balance sheet will keep producing some tremendous earnings growth. In short, the Albertsons of today is a much better company than that of 2018 or 2015. And look, with this latest big COVID outbreak in the South and West, the supermarkets could end up getting more of a boost than you might expect. Obviously, it's temporary. It's pantry stocking. But there's a big difference between 3 months of insanely high sales and 6 or 9 months of insanely high sales. Thanks to all this improvement, when Albertsons says they plan to pay a dividend with a target yield of 2.5%, I believe them. I love it when a company comes public with a dividend. All right, but there are still some negatives. Cerberus will remain in control of the company even after the IPO. Either Cerberus sells later, putting pressure on the stock, or the public shareholders don't get a say in how the business is run. Not that great. Plus, the grocery business is incredibly competitive. This is what I worry about. Lots of players with deep pockets, especially Costco and Walmart, and I think the industry could be in a tough spot once we get a COVID vaccine. But put it all together, and I think that Albertsons could be worth owning. But, and this is the big but that I didn't have to feel like when the great merchandise came. Now it's got to start coming at the right price. I say something no more than $24, $25. It's definitely not best of breed, but it's not garbage either.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.